Hi everyone, my name is Mark Quinn. I'm a tax advisor and chartered financial planner with the Spectrum IFA group based in Portugal. And in this video I'm going to look at the key investment choices for investing as a Portuguese tax resident, with a particular emphasis on what's called Portuguese compliant offshore investment bonds. So there are quite a few choices that you have to invest as a Portuguese tax resident, and the main ones are directly held collective investment funds or stocks and shares portfolios. You also have trust solutions, pension options, portfolios structured within companies, and offshore Portuguese compliant bonds. And really the aim when you're putting together portfolios is to try and trap gains and income within the actual portfolio. So you want to avoid any capital gain and income being distributed on an arising basis, because then you're not able to actually control the timing of taxable events. So that's the key aim of using these types of different vehicles, and sometimes it's the best solution is actually to use a combination of several different choices. And one option I'm often asked a lot about these days is the Portuguese compliant bond. Now, there's quite a lot of benefits to using this type of structure, but first let's talk about what it actually is. And from a legal point of view, it's actually called life assurance. It's structured as a life assurance policy, and these are quite commonly used across Europe in general, and certainly in the UK as well. They're used both onshore and offshore versions. And effectively what they are is they're just a wrapper, they're just a shell. So in the same way as there's a pension scheme is a wrapper or a shell from a UK point of view, and individual savings accounts are wrappers, this is just another form of tax wrapper. And in that shell you can put a wide choice of investment funds and portfolios together. So let's just look at the key benefits of the Portuguese compliant bond. So the first one I've already alluded to, and that's the ability to have no tax deducted on either the income or capital gains within the fund. So there's a full tax deferral, and that's often known as gross roll-up. And this leads me to the next point, which is that you can control the timing of any future tax liability, and this can be particularly beneficial because you can time it to suit you rather than when the actual income is created or when the gain is created. You also have low effective tax rates when you're withdrawing funds from a Portuguese compliant bond. And although the starting rate is 28%, the Portuguese government actually incentivises you to use this type of structure by giving you tax breaks after 5 and 8 years. So after 5 years, your tax reduction is 20%, so the net rate would be 22.4%. And after 8 years, the tax again reduces by 60%, so instead of 28%, you're paying 11.2% tax. Bonds also have a benefit from a succession planning point of view, because they're structured under EU contract law, and they don't have to go through any legal process in order for the proceeds to be distributed to your beneficiaries. So what you would do is you would just complete a beneficiary nomination form as part of the contract, and in the event that something happens to you, it automatically is distributed to the people you want to receive the benefit. There's also potential inheritance tax savings. So from a Portuguese standpoint, there's no inheritance anyway. It was abolished in 2003, but there is a form of stamp duty that applies if you're leaving assets to non-direct line descendants or ascendants, or to your spouse. So if you're not leaving it to those individuals, there could be a tax charge, but it only applies if it's a Portuguese-based asset. And because we structure these bonds outside of Portugal, no tax will be applied. From a UK context, it's a bit more complicated because your liability to inheritance tax is actually based on your domicile. Now, if you do manage to lose your UK domicile of origin in future, you want to make sure that there's no UK assets available to tax, because even if you're a non-UK domicile, any UK assets will still be subject to 40% inheritance tax. So again, because we're structuring them outside of Portugal and outside of the UK, there could be potential savings there in future. There's also a lot of flexibility when you're thinking about investment and portfolio management. And this comes in two forms. So the first way is that you're free to pursue any investment strategy you wish, rather than pursuing an investment strategy dictated by the tax implications of doing that. Because we've seen some clients where the fund manager is running the portfolio on a dividend-focused strategy, for example, simply because they're worried about the capital gains tax implications. If you're managing the portfolio within this type of wrapper, you don't have those limitations. You're completely unconstrained as to what you do and when you do it. There's also no tax if you switch between different strategies. So, for example, if you wanted to switch between different fund managers or different holdings, if you're doing that directly held, it's going to create a tax issue. Whereas if you're doing it within the confines of a tax wrapper, again, there's no tax issues created. And the third aspect of the investment choice and flexibility is that you can put anything you want to within reason within these types of structures. So you can hold directly held shares, investment funds, exchange traded funds, etc., etc. It's pretty much unlimited investment freedom. The bond structure is also very simple and easy to manage on an ongoing basis. And I'm thinking particularly along the lines of the tax declarations you have to do here in Portugal. So every year you're going to have to complete your annual IRS tax declaration and report any income and gains that you've enjoyed during that year. By using a bond, it's very simple because the company will summarise for you at the end of each year how much you've had and how it's supposed to be declared. So it's very, very easy to manage from a tax point of view. The investments are also very portable, so the structures we set up don't just work from a Portuguese standpoint. They're very efficient whilst you're a Portuguese tax resident, but we can also set them up in order for them to maintain their tax efficiency even if you return to the UK in future. And this actually leads me to my next point, which is the benefits of time apportionment relief. Now, time apportionment relief is a UK tax concession, and it says that if you've held an investment bond that's grown in value, any growth in that value that occurred whilst you've been a non-UK tax resident will be completely washed out. So for example, say if you set up a portfolio today with €1 million and it grows to €2 million, then if you return to the UK doesn't see the £1 million of investment growth. They just see you returning with €2 million of fresh capital. So you're re-entering the UK tax system with clean capital with no inherent taxable gain. So in that sense, the bond can act as a good future-proofing of your affairs if you are relocating to the UK or elsewhere. It's not just the UK that you can incorporate these portability options. Another important point to make clear is that these advantages, the bond advantages we've just discussed, are actually applicable whether you're a non-habitual resident or not. So you're going to enjoy the same tax concessions. So if this type of structure does appeal to you and you want to consider using this type of investment, then we can help you. And we can help you in a number of different ways, because the bond is very much a generic structure, but it has to be personalised to your affairs. So the first things we'll be doing with you is to look at which jurisdiction is best to hold this structure based on the double taxation treaties with Portugal. We'll then analyse and compare the different companies within that jurisdiction and which company is best for you. We'll help you choose your fund manager and also investment strategy. So are you going to pursue a discretionary fund manager approach, a managed approach, or go down the fully passive route by using exchange traded funds or index trackers? We can also analyse the different contractual options you can incorporate into the policy at outset, such as the ability to have a UK option there ticked. So if you do return to the UK, the bond can be taken back as is and will continue to be fully tax efficient as a UK tax resident. We can examine and analyse currency options for you on two levels. The first one is to look at what the currency will be for the bond as a whole, and the second is what currency choices and options should you use for the underlying currency holdings, the underlying fund holdings. And the final 2 points are that we can look at how this incorporates with your succession plans and will planning in general. And that could potentially involve the use of trust options as well, which we can incorporate for you. So I hope you found that useful, and if you've got any more further questions on these investment choices or any other options that we discussed today, please let me know. Thank you.